Peter Rose, Longwood Currency Trading. Mid-stage position management, catching the big move. What is mid-stage position management? How do you catch the big move? That's what I'd like to chat with you a little bit about today. If you don't get your position management correct, or you don't know what you're doing in the position management phase of the life cycle of a currency pair, you're going to mess it up. It's just not going to happen for you, and you're going to miss those big moves. Right. Beautiful day out. My wife always says, why do you think that when it's raining and foggy out that it's a beautiful day? Every day is a beautiful day, but I appreciate the fog and the denseness of the woods and all that. You look out, we're in mid-October, and the leaves are just not only beginning to completely finish their change in color, but we're also beginning to lose them. They're starting to come down. If you can see across the street, they're really starting to thin out. I would think that we get a big rainstorm or something like that, and wind, we'll probably drop 40% of them. Won't be long. What's that got to do with position management? Well, we're in mid-stage fall, mid-stage position management. Mid-stage is really a critical area, and if you don't understand how to manage that, you're going to miss the opportunity to gain the really big moves. And so that's really what the function of doing analysis in the position management phase of the life cycle. You're not done with your analysis just because you get your entry right, okay? Right. So if you watched any of my videos, any of them, really, there are 240 of them or something like that, but I always talk about the life cycle of a currency pair. You have your entry analysis, position management, and exit methodology. And so the transitions between those stages, there are some direct boundary conditions that indicate when you get into that stage. But let's assume that you understand that and that you are in the position management phase. You can break position management up into three sections: your early stage, mid stage, and late stage. Early stage is right when you get in there. There's some things that you need to do in order to well, it has to do with risk management and making sure that just because you're in a profitable position, that your current price action is reflected in your plan as being perhaps different than what it was in your entry stage. And I mean, this can be seconds, but you have to be willing to make that judgment so that early position management stage sets you up to have a good position to manage. Otherwise, you're going to slip into a negative territory and you're not going to know what to do. The mid stage is probably the least discussed that I've seen out there. Folks that are teaching tend to jump from, oh, here's how I got in, and now this is where I'm going to get out. And they miss that position management. Well, they catch a little bit of the early stage, but it's the mid stage that's really important that you look at. And the reason I say that is because when you do your entry analysis, you're setting your stop loss, and you've got to have some vague idea of a profit target, right? Why get into a trade if you don't think there's going to be a profit? So you set a target. You can't be fixated on that profit target once you get into the position. The profit target says, oh, I've got enough pips here that if I'm correct on the price momentum, I could probably get to that state, that level. Probably. And it's a probabilistic analysis that you do. Once your position is moving in profit, then you're in position management. You're going to manage that position to get to the profit target. Are you really? No. And this is the key. what you're doing in that mid-stage position management is you're trying to determine how valid your estimation of the price momentum is. How valid is that? Because if you entered correctly, then the momentum on price is sufficient to get to the profit target. So the question, once you're in position management, is does the price have more momentum to go beyond the profit target? And this is the key I think that a lot of folks miss, is they do their entry analysis and they step their limit orders in. If you're going to be staging, set your stop, move your stop, profit target, set and forget. That's where I really start working, is the mid position management stage, because I'm moving my limit orders all around, all over the place, and changing my profit target all the time. Because what I'm doing is I'm looking for the big run. I'm trying to see, it's like an ocean wave. You know, the surfer gets on there and you'll see a lot of the times they'll get up on a wave and then they'll kick out. Why? Because they thought that it was going to be a good wave that would carry them all the way to the beach in great froth and everything. But they get on the wave and they go, oh, no, this just doesn't feel like it has enough juice to it. And they get off. And that's what your position management, mid-position management phase is all about. Are you going to kick off that wave? You get in there and price is going and you go, oh man, this hasn't really got the juice I thought it had. Get out, kick out, try it again. If it goes on without you, you have the decision to get back on if you want. In surfing, you can't do that. Once the wave is gone from under you, you can't catch up to it. But in currency trading, you can't. Just look at the chart. Does it warrant another entry? And you have to do the entry analysis all over again. But you've kicked out, and so you've made 3 pips, 8 pips, 10, whatever, wherever you're at when you decide to kick out. But let's say you're staying with that, and you go, man, this thing has got a lot more juice. You've got to change your parameters for your exit methodology stage. You've got to say, where does this thing have the potential to get to? You know, order flow isn't a constant thing. You don't just have a bunch of orders and they're coming across the wire, and you can say, oh, I've got a $4 billion order here that I'm tracking, and he's doing 300 million at a pop. It doesn't work that way. The institutional traders will trade in various size batches of orders in order to satisfy the requirements of their client. I don't want to pay more for my money than this, and I refuse to sell my money for less than this. There's a range that broker, that trader is working on. It's like if you're looking for a house. You tell your real estate broker, I'm looking for something between $200,000 and $400,000. The broker isn't going to come and say, hey, would you like to buy this $700,000 house? It's a much better house. Well, yeah, but I don't have the money to afford that. 4 is the best I can do. Well, how about this $600,000 house? That broker isn't going to be a broker for very long. People aren't going to trust them. And so in your position management, you have to be very alert and do most of your heavy lifting to determine if that price has the momentum to go beyond your profit target. Do you want to move that profit target? Do you want to move your stop? What are you going to be willing to do? You're in profit because you're in mid-position management, okay? Do you bring your trailing stop up 10 pips below? Do you leave it at 20 pips below? Do you bring it up tight? When would it be appropriate to bring it up tight? What do you do with your profit target? I had a profit target at 25 pips originally from my entry. Do I want to move that 200 pips out? Do I want to move it 2 pips out? For the risk that I'm taking, for the percentage move that I make on the profit target, my new profit target, what would be a good value for a differential? God forbid you'd want to stage out of a profitable position. Particularly if in the United States, and I don't know where else this has happened, where we base our trades on FIFO rules. You know, a lot of the advice that you're seeing on these videos are coming from people that are in relatively unregulated environments. Anybody that will let you trade 100 or 200 to 1 isn't applying FIFO rules or anything else to their trading requirements. And so what you're able to do there is radically different than, for example, the advice that I give for where I am in the United States. You have 5% margin rule, you've got 50 to 1 maximum leverage. You know, you are, it's not complicated, but you could say, you know, I got 200 to 1 leverage, I could take 10 grand and trade 40 lots. Well, yeah, but the 3 pip move is going to kill you. It's going to take you 10 grand and wipe you right out. Right. 40 lots is... Oh, God. $400 a pip. You take 5 pips, you're more than gone. So let's look at the position that you're in. Price has moved and it's very close to your profit target. Do you want to let it go to the profit target? Do you want to kick off the wave at that point? Do you want to get out and keep the profit that you have rather than risking, oh, it's only got 5 more pips to run, but if it turns around and runs 8 pips against me before I get the grapes to get out, I'll only get 2 pips on the trade where I could have had 20 pips. Those are decisions that when you're starting out and learning to trade, you don't want to have to make. You make them up front during your entry analysis. And you are thus highly risk managed, okay? As you gain more experience and your bank size increases, then you can begin to expand into these more advanced areas. I'm not advocating changing anything in mid position management stage if you're trading a 4-figure or a low 5-figure account, because you don't have that flexibility to do that. And as soon as you start screwing around with it and you don't have the general overall experience, you're simply not going to be successful with that. And don't give me this shit that that's all the money you have is the ability to trade 2 full lots or 3 minis, and so therefore that's the best you're going to be able to do, so you're going to start staging and compounding and doing all this other stuff. You don't have experience. If you had the experience, you'd be trading a mid 5-figure account. And you could start really thinking about trying to do some of this stuff once you get up into the high 5 figures. Oh, well, I don't have the money to do that. Then you shouldn't be doing this type of trading. You should be learning it because someday you'll have that money. Particularly if you're running a 200 to 1 leverage and you're playing this stuff. I don't advocate that. I don't advocate at trading at 200 to 1 leverage. At all. However, if you have the availability to trade at 200 to 1 leverage, there's a great place that you should go in and utilize that. But it certainly isn't at entry. At entry, you should be highly risk averse. You should manage that trade just tighter than shit and not go over 50 to 1 leverage and have 5% of the cash value of the currency as your margin, regardless of what they say you could put up. You don't want to be put up. If you put $10,000 up, you should be trading 1 lot. That's it. And I only trade in full lot increments because the math is easy. It's easy to balance. I don't have any stress in my trading at all. I keep the numbers easy. I multiply by 10. This is what's going to happen. Everything is okay. So if I'm trading one full lot, it's on a $10,000 bank because I need $5,000-$6,000 in margin. If you're trading a currency pair that only has, $2,000 in margin requirement, well, you could get away trading a $4,000 per lot account. But now you're changing the way that you're thinking. Well, for this currency pair, I'm going to trade one lot with $4,000, and I'm going to base my return on that, and then I'm going to apply 200-to-1 leverage to that. How are you ever going to determine what your trading metrics are if you have all these parameters changing all the time? This is what I'm talking about, this mid position management stage that you're going to be in. You want that to be simple. It's a complicated swill of stuff that's going on in your position management. You don't want to be farting around trying to, I'm trading at 201, I'll put a little bit more money up, I'm doing this, I'm doing that, I'm trading 30 lots when I should be trading 18. Just let's calm down. Because if you keep things simple, then the decisions that you need to make in real time become simple. They become binary. I'm going to do this or I'm going to do that. If you're adding too many variables into the mix, you're going to screw it up. Look, I was a software engineer for 33 years designing complex business applications. It's difficult enough to be software engineering, but it's extremely difficult to do business applications because not only are you concerned about the programming aspects of it, but you have to constantly be concerned about the business application that you're programming against. And so in trading, it's relatively straightforward. Here's the market. It's a chaotic market. But you need to find the symmetries within that chaos. And that's simple to do if you keep everything else simple, right? So that when you get to that mid-position management stage, you can look at that and go, this thing's got enough juice to go beyond the profit target, perhaps to the next structural level or some level that you have out there if you're doing support and resistance stuff, or maybe price action is adhering to some of the moving average lines, and so that's your guide as to where you think that's going to go. Maybe your price is in a regression to the mean or a reversal from a regression to the mean, and you can do a probability analysis of how far that price is going to go. I'm in a situation right now where I'm, what am I underwater here? $4,000 underwater because I had a regression to the mean, but I didn't want to lose my position. I went from about $500 underwater to $4,000 underwater. But that's okay because of the time period that I'm trading, the time frame that I'm trading on, and the momentum in a biased direction that I have, and my familiarity with the underlying economic things that are going on. It's all of that stuff. Now, is it that complicated? No, it's not that complicated. I just have those extra layers that I can add on to it. But pinning the thing at its base level is, does price have the momentum to continue moving in the direction that it's going in? And that's all you really have to know, because then you can watch that closely to make a decision as to when it's losing that momentum. And as soon as it starts losing that momentum, like the surfer, you kick out of the wave. If the momentum is continuing, you stay with that. And if your current price is a significant distance from your average price of your position, you might consider staging into that. And you say, oh, well, yeah, but then if it turns around, then I'm going to lose that. Yeah, but the idea in staging, and again, I've done several videos now on staging, is that you want to stage early so that as you stage late and small, a retraction against that is going to be a small loss, and then you're gone. When you've lost on that last stage, you stage in one lot, or maybe you do a 2 lot as a small stage, and then when you price drops below so that you're losing on that last 2 lots that you put in, you've got 4 or 5 lots that are averaged way down here that's just moved, that 2 lots just moved that the average price up a little bit, so you cut that and run, and yes, you lose that, and you lose a little bit because of the change in the average price, but you've gained on the 4 lots that you've got already in play. You have to be really careful in that mid-position management stage in order to keep your eye on the ball of 2 things. Number 1, protect those profits, be really risk averse. And number 2, if that price momentum is going, you want to back the truck up and just load into that and ride it as far as it'll go. But you can't just indiscriminately back the truck up and bring your average price up to within 4, 8, or 10 pips of where the current price is, because you're going to get tagged out on the whole thing. And then if you got 6 lots running and you drop 5, or you let it go 5 or 10 pips below, you're at $60 on 10 pips. Right? You're going to take a $600 loss just like that, boom, and you had all the hopes in the world for making a couple of $1,000s. So you have to be really, really, really careful. That mid-level position management, take a look at that in your trading now. Even if you're doing all in and all out, look at that movement of price in that mid position. Don't just get fixated on the profit target you have. Start looking at the base that price action is building. That base is created by order flow. That trader is loading in and into that market either to buy or sell. So let's say we're talking long. He's going in there and he's trying to satisfy his client order. If it looks like it's early in that campaign, you could get onto that wave heavier and ride it as that order flow is going forward. You just have to watch it for when they stop, because a lot of times they'll sacrifice tens of millions of dollars to pull the price back so that they can run it back up again, because they're reaching the boundary of what their client is willing to pay or sell. And that's I mean, it's order flow. They're not stop hunting you. They're doing their business. If you happen to be in the way of that, like the truck or the wave, you're just going to get mowed down. Mid-stage position management is critical in order for you to realize those 3 times, 5 times, sometimes 10 times your original profit target. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.